The global movement to promote crypto tax transparency, what you need to know. In Europe and the US, there are a host of initiatives placing new requirements on participants in digital asset markets to report on transactions and meet other new provisions. This op-ed is part of CoinDesk's Tax Week, presented by TaxBit. Erin Fennimore is the VP of Tax Solutions at TaxBit. The digital asset industry has seen significant regulatory movement in the United States and abroad, all to promote tax transparency. This trend for global transparency is driven by many factors, such as tax evasion and avoidance, and the overall goal of ensuring a fair and transparent global tax system. The primary vehicle of tax transparency is the exchange of information between enterprises and local tax authorities. Outside of the U.S., the Organization for Economic Cooperation and Development (OECD) and G20 have led the initiative to promote global tax transparency. This article will help highlight the key takeaways from the proposed digital asset broker regulations in the U.S. and other key initiatives across the globe, highlighting important commonalities and timelines. U.S. Proposed Digital Asset Broker Regulations, the U.S. Treasury Department issued proposed regulations clarifying the definitions, requirements, and implementation timelines for digital asset brokers' tax information reporting requirements as outlined in the Infrastructure Investment and Jobs Act (IIJA) passed by Congress in 2021. See also, the IRS should offer a free tax reporting tool to defy users' tax week. These proposed regulations are designed to help end confusion involving digital assets and provide clear information and reporting certainty for taxpayers, tax professionals, and others, said IRS Commissioner Danny Werfel. The regulations are a significant step in the regulation of digital assets in the United States. They are expected to have a significant impact on the digital asset industry. The regulations are also expected to increase transparency in the digital asset market and help combat money laundering and other financial crimes. Key takeaways. It is important to note that these regulations are not finalized. The IRS is accepting comments on the proposed regulations and held a virtual public hearing on November 13. All comments made to the IRS are public and can be viewed on the Federal Commentary Docket website. The key areas that highlight the impact on the digital asset community are summarized below. Digital asset broker. A digital asset broker in the proposed regulations is defined as any person who provides services facilitating the sale or exchange of digital assets, including centralized exchanges, digital asset payment processors, and certain decentralized protocols where there is sufficient control or influence over the protocol to make changes to it. Along with the clarification and more narrowly tailored digital asset broker definition, the proposed regulations refine the language to focus on three types of enterprises. Centralized exchange operators that facilitate digital asset transfers on behalf of users, digital asset payment processors, decentralized protocols accessible to U.S.-based individuals that meet certain requirements. The third categorical example necessitates the most nuanced analysis. At a high level, an enterprise that falls into the third category will need to determine if two factors are met under the proposed regulations, provides a facilitative service, and based on the nature of the service, would know or be in a position to know both 1. The identity of the party making the sale, and 2. The nature of the transaction potentially giving rise to the proceeds from the sale. Looking at the first factor, the regulations define facilitative services as facilitating the sale or exchange of digital assets regardless of whether that is done through an autonomous protocol, access to a trading platform, automated market maker systems, or any order matching service. This approach illustrates the Treasury's understanding of how digital asset trading services differ from traditional financial broker services. Regarding the second factor, the regulations explain that a person would know or be in a position to know if they can set or change the terms under which the services are provided. This focuses on whether a person has sufficient control over an autonomous protocol to make changes, updates, or otherwise influence its operation. Suppose the DeFi protocol can be managed, controlled, or overwritten by a centralized group in any way. That protocol will likely be viewed as sufficiently centralized to be treated as a digital asset broker. Conversely, suppose the protocol truly operates autonomously without any oversight, intervention, or influence from a particular group. In that case, it will not be considered a digital asset broker and not be subject to the reporting requirements. Along with helping to define who is in scope, the proposed regulations specified who will be considered out of scope, including miners, stakers, and wallet software providers. Digital assets defined. Digital assets are defined as assets that include any digital representation of value that is recorded on a cryptographically secure distributed ledger, even if not every transaction is individually recorded. These proposed regulations clarified that stablecoins and non-fungible tokens (NFTs) are considered in scope and is already a key area of focus for the commentary that the IRS has received. Form 1089, Reporting. The core function of being a broker involves broker-related onboarding procedures, cost basis tracking, and ultimately 1999B reporting. Historically, Form 1999B has been used in traditional finance to report the required information. Although not specifically referenced in the proposed regulations, the IRS has commented publicly about creating a new Form 1999A to be used for digital assets. See also, Form 1999B is not the solution to your cryptocurrency tax woes. Tax Week 2023. Similar to reporting on traditional financial assets, digital asset reporting will require a broker to include the following pieces of information for each transaction: name, address, taxpayer identification number, digital asset details, name, type, number of units, date and time, UTC, gross proceeds of the sale, and adjusted cost basis, transaction ID or hash. Digital asset addresses involve form of consideration received for assets that were transferred into a broker and subsequently disposed of. The following information will also be required: date and time of such transfer and transaction ID or hash of such transfer and transaction, digital asset address or digital asset addresses if multiple from which the transferred and digital asset was transferred, number of units transferred and by the customer as part of that transfer and transaction, customer tax onboarding requirements. To effectively comply with 1999 reporting, digital asset brokers will need to know who their customers are for tax reporting purposes. This means they will need to be able to identify and collect the following information for reportable accounts: identification of accounts as U.S. or non-U.S., collection of names, addresses, and certified U.S. tax identification numbers. TIN brokers within the traditional finance industry currently have an obligation to collect certified tax identification numbers, TINs. Accordingly, digital asset brokers will assume that same obligation. This requirement will impact digital asset customer onboarding in a significant way. Digital asset brokers will be required to collect certified taxpayer identification numbers, TINs, achieved by collecting a Form W-9 or substitute W-9. The information collected on a Form W-9 is used to populate and file Form 1999B and the new Form 1999A specific to digital asset broker reporting. Global trends for tax transparency. The U.S. is not the only country issuing regulations related to digital asset tax transparency. With the rise of use cases with digital assets across the globe, there has been a myriad of proposals and frameworks that have also arisen for enterprises within digital assets and e-money. While the objectives of these frameworks and regulations all center around tax transparency, it is important to understand their differences, timelines, and impact to your enterprise. Crypto Asset Reporting Framework. On October 10, 2022, the 38-member country OECD published the final guidance for the Crypto Asset Reporting Framework (CARF). It read, in light of the rapid development and growth of the crypto asset market. On November 10, approximately 47 countries published a statement that they plan to swiftly transpose the CARF into domestic law and intend for active exchange of information to commence by 2027. The intended effective dates for the remaining 38 countries are still unknown, but the OECD intends to work towards global adoption and implementation of the framework, so it's incorporated into the local laws of member states. The DAC 8. On the heels of CARF, on DEC 8, 2022, the EU Commission issued the 7th Amendment to the Directive on Administrative Cooperation (DAC). The adopted directive entered into force on November 13, 2023 in EU. Member states will have until December 31, 2025 to transpose the new rules into local law, with the first application from January 1, 2026. The DAC will extend the scope under DAC to crypto service providers on exchanges and transfers of crypto assets and e-money. The provisions of DAC have significant overlap with CARF and will ultimately mean that crypto asset service providers will be obligated to report certain information about transactions involving EU residents. Markets in Crypto Assets Regulation (MiCA). On June 30, 2022, the European Parliament and Council reached a provisional agreement on the Markets in Crypto Assets (MiCA) regulation. MiCA's objective is to increase the safeguards for digital asset investors by requiring common EU-wide definitions and rules. MiCA requirements will be effective as of December 30, 2024. See also U.S. Crypto tax proposal lets miners off the hook. As a result, crypto asset service providers operating in EU providers will be required to have registered offices within the trading bloc. CESIP, the Central Electronic System of Payment Information. CESIP is a new EU initiative to combat value-added tax (VAT) fraud related to cross-border payments. By COIN 2024, payment service providers in the EU will be required to report cross-border payments on a quarterly basis. This initiative aims to bring transparency and compliance to cross-border transactions, particularly those involving e-money institutions. Crypto exchanges should be aware of CESIP as it will likely have an impact when an exchange facilitates the buying and selling of cryptocurrencies between a buyer and seller across different EU member state. CESIP reporting will be triggered when a buyer i.e. pair is located in the EU and has engaged in a cross-border transaction with a seller i.e. payee in either an EU or non-EU state. CESIP limits reporting in a variety of ways, primarily by requiring 25 or more cross-border payments to a seller i.e. pay. CoinDesk does not share the editorial content or opinions contained within the package before publication, and the sponsor does not sign off on or inherently endorse any individual opinions.